The US $37 trillion crypto reset isn't a headline anymore. It's a live event, and if you're holding dollars, bonds, or even sitting in cash right now, the next 12 months decide whether your purchasing power quietly survives or gets shaved down without you noticing. Most people think the danger already passed when inflation peaked. That's the trap. The real damage doesn't happen at the spike. It happens after, when policy shifts look harmless, even helpful, and the math quietly starts working against you. Because what's happening right now isn't a crash, it's not panic, it's not emergency language. It's calm decisions made in public that only make sense if you zoom out and follow the incentives all the way through. And once you see it, you can't unsee it. Let me place you inside the moment that matters. Rates were supposed to stay where they were. That was the message. Inflation wasn't dead. Growth wasn't collapsing. Jobs weren't imploding. Yet rates were cut anyway. Not unanimously, not quietly, but cut. That single move changes the trajectory of everything tied to the dollar. Here's the part most people miss. This isn't about helping markets breathe. It's about making $37 trillion of debt easier to live with without ever saying the word default. Because you don't default when you can shrink the problem instead. Think about what happens when rates fall while inflation stays sticky. Cash yields fall first, savings accounts lag, bonds reprice, and suddenly holding dollars feels uncomfortable again. Not catastrophic, just uncomfortable enough that you start looking for alternatives. That discomfort is the mechanism. And this is where crypto quietly enters the picture, not as rebellion, but as infrastructure. A few months ago, talking about a crypto-enabled debt reset got you labeled dramatic, conspiratorial, over the top. Now the language has shifted. Officials are saying the quiet parts out loud, growth targets that don't line up with reality, pressure on central banks that's normally off limits, policy moves that contradict the textbook but align perfectly with incentives. That's not coincidence, that's coordination. Let's slow this down, because speed is how people miss the danger. The United States does not need to pay back $37 trillion. It just needs to make that number less painful relative to everything else. And inflation does that better than any tax hike ever could. If you owe $100 and the value of that dollar drops by 20%, your real burden just shrank without renegotiating anything. Now scale that logic to sovereign debt. Inflation doesn't erase the number, it erodes the meaning of it. But here's the problem. Inflation hurts voters. It's visible. Groceries, rent, fuel, people feel it immediately. So it needs a partner, something that absorbs the pressure quietly, off balance sheet, and preferably looks innovative. That's where stablecoins come in. Stablecoins look like crypto. They feel digital, they move fast, they trade globally. But structurally, they do something very old-fashioned. They create demand for government debt. When someone parks $1 in a stablecoin, that issuer doesn't store it in a vault. They buy short-term treasuries, bills, notes, government paper, and they earn the yield. That means every new stablecoin dollar is effectively a new buyer of US debt. Now here's why that matters right now. Foreign buyers have been pulling back, not loudly, not dramatically, just steadily. After seeing reserves frozen, access restricted, assets politicized, trust eroded, you don't need a speech to understand that message. So the buyer base shifts inward, domestically, digitally, through products people think are neutral. That's phase 1. Phase 2 is where people get hurt if they're not positioned. Phase 2 is lower rates paired with ongoing inflation. Because once rates fall, borrowing accelerates. Asset prices rise, leverage gets cheaper, stocks float higher, real estate stretches again, crypto catches a bid. Everything priced in dollars starts to lift. Except wages. Wages are slow, sticky, negotiated, lagging. So the person with assets sees appreciation. The person with income sees erosion. That gap is the wealth transfer. And before you assume this is accidental, listen to the language being used. Claims of explosive growth. 20% GDP numbers being floated like they're plausible. That's not real growth, that's nominal growth. Real growth is productivity, output, efficiency. That takes time. Nominal growth includes inflation. 3% real growth plus 17% inflation equals 20% headline growth. On paper, it looks miraculous. Politically, it looks like success. But your life doesn't feel better. It just feels more expensive. Now zoom back to the rate cuts. Cutting rates when inflation is above target and employment is stable is not neutral. It's a choice. And it's a choice that benefits debtors over savers. Who is the biggest debtor in the room? Exactly. Now layer crypto on top of this and something interesting happens. Crypto is volatile. Everyone knows that. But volatility isn't the enemy in an inflationary regime. Stagnation is. When cash yields fall below inflation, holding cash becomes a guaranteed loss. Slow, quiet, but certain. So people move into anything that at least has a chance of outrunning inflation. That's why crypto performs best not during chaos, but during monetary easing, and this is one of the most misunderstood things in the entire space. People think crypto thrives on fear, on collapse, on panic, on headlines screaming that everything is broken. That's not actually true. Those moments create attention. But attention doesn't move markets sustainably. Liquidity does. Chaos is when people sell whatever they can. Easing is when people buy whatever they can justify. And that difference matters more than most people realize. During chaos, capital hides. During easing, capital looks for somewhere to go. That's why this moment matters more than the panic moments everyone obsesses over. The panic moments feel dramatic, so they stick in your memory. But the real positioning happens when nothing feels urgent yet. This is the calm phase. This is the phase where headlines are boring, policy language is technical, and markets grind instead of explode. This is when people underestimate what's being built underneath the surface. And this is exactly where positioning happens. Not when everyone agrees, not when conviction is obvious, but when incentives quietly start shifting and behavior changes before narratives catch up. Now let me be very clear before we go any further, because clarity here actually matters. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. I wanted that right here, not buried at the end, not rushed through, not glossed over, because what comes next isn't about telling you what to buy or what to sell. It's about helping you understand the terrain, because walking into a shifting environment without understanding the ground beneath your feet is how people lose money even when they pick the right asset. Most crypto investors spend their time watching charts, narratives, cycles, halvings, headlines, price predictions, social media sentiment. And none of that is useless, but none of it is the main driver. The real driver is liquidity. Liquidity is oxygen. Without it, nothing moves. With it, almost anything can. When rates fall, liquidity expands. That's not an opinion. That's mechanics. Borrowing gets cheaper. Cash yields fall. Holding money becomes less attractive. Risk tolerance rises. Not because people feel brave, but because they feel pressured. When liquidity expands, risk assets breathe. And crypto is one of the most liquidity-sensitive assets in existence. It doesn't need mass adoption headlines to move. It doesn't need everyone to suddenly understand it. It doesn't need a perfect narrative. It needs excess dollars looking for velocity. Dollars that don't want to sit still. Dollars that are slowly being punished for doing nothing. Dollars that start asking the same question over and over again. Where can I go where I at least have a chance to outrun this? That's what's forming right now. Quietly, gradually, without fireworks. And it's not just the US. Europe is signaling easing. Japan never stopped. The UK is boxed in by debt, demographics, and stagnation. Different political systems, same constraints. Everyone has the same problem. too much debt, aging populations, slowing productivity, and one politically acceptable solution: inflate together. Because if everyone eases at once, nobody looks reckless. If every major currency weakens at the same time, relative exchange rates stay stable. No one country takes the blame. No one currency collapses in isolation. But purchasing power declines globally. That's the coordination nobody needs to announce, because it doesn't require a meeting. It's driven by shared incentives. Now here's the uncomfortable truth. This environment is incredible for people who understand it, and brutal for people who don't. If you're already holding assets, this is tailwind territory. Things don't have to be perfect. They just have to float higher as money looks for exits from cash. If you're holding cash, this is erosion territory. Not overnight, not dramatically, but steadily, quietly, month by month. And if you're somewhere in between, indecision is the biggest risk. Because doing nothing feels safe, but in an inflationary easing environment, doing nothing is still a decision. Crypto investors sit in a strange middle ground: high upside exposure, but often poor macro awareness. People know the tokens, but not the system they float inside. They know the stories, but not the plumbing. That's why so many people get chopped up in crypto over and over again. Not because they're stupid, not because they picked the wrong asset, not because crypto somehow failed or the technology didn't work. They get chopped up because they don't understand the timing pressure that liquidity creates. Liquidity doesn't just move prices, it compresses decision-making, it changes behavior, it rewards speed early and punishes hesitation later. And if you don't know which phase you're in, you react emotionally to moves that are completely normal for that part of the cycle. Here's a simple mental model, and this matters more than any indicator you'll ever look at. Liquidity rises, assets inflate, volatility increases, narratives multiply, late money chases, then policy tightens again. That sequence repeats every cycle, every asset class, different scale, same rhythm. When liquidity rises, money has to go somewhere. It doesn't sit still, it leaks into assets. First the obvious ones, then the riskier ones. Prices move before fundamentals change. That's important. Price moves first. As prices rise, volatility increases. Bigger swings, faster moves. That volatility creates stories. Narratives start forming. People begin explaining the move after it already happened. Those narratives attract late money. People who didn't want risk suddenly want exposure. They chase because standing still feels worse than being wrong. And that's when policy tightens, as liquidity slows, pressure builds, the same assets that floated up start pulling back, not because the story is dead, but because the oxygen supply changed. And most people experience that as betrayal. Now, if you mistake the inflation phase for organic growth, you overextend. You assume it's sustainable. You convince yourself this time is different. You size too big. You stop managing risk because it feels unnecessary. You don't think you're being reckless. You think you're being confident. Then, when conditions tighten, you're trapped. You don't have room to breathe. Every pullback feels existential. On the other side, if you mistake the tightening phase for failure, you panic. You assume the story is over. You sell when liquidity dries up. You conclude the whole thing was a mistake, when it was really just a pause. That's how people get shaken out at the exact wrong moment. They don't lose because they were wrong about the direction. They lose because they didn't understand the phase. The people who survive cycles aren't the ones with the boldest predictions or the loudest conviction. They're the calmest. They're the ones who understand where they are in the process, not just what the price is doing today. They don't confuse movement with meaning. They don't confuse volatility with failure. They don't confuse patience with inaction. And this is where education matters more than ever. Not signals, not hype, not shortcuts, not someone telling you they have the answer. Education that teaches you how to read environments, not just charts. Charts tell you what happened. Environments tell you what's likely. That distinction is everything. This is exactly why cheeky school exists. Not to promise returns, not to sell fantasies, not to tell you there's a secret trick nobody else knows. but to train people to understand the system they're participating in, manage risk intelligently, and stay solvent long enough to benefit from cycles instead of being ejected by them. Because in environments like this, survival is the strategy, and survival is what lets opportunity compound. If you can stay in the game while others are forced out, time starts working for you instead of against you. And that matters because this is not a one-year story. This is a multi-year monetary transition. Stablecoins will expand because they solve problems quietly. Tokenization will accelerate because it makes existing systems more efficient. Traditional finance will merge with crypto rails not through announcements but through necessity. And volatility will remain the price of admission. If you're a crypto investor who only thinks in upside terms, this phase will hurt you emotionally. Every pullback will feel personal. Every delay will feel like failure. But if you think in probability and positioning terms, this phase becomes navigable. Now let me bring this back to you personally, because this is where it actually matters. Ask yourself one honest question. If inflation runs hotter than expected and rates stay lower than expected, what happens to the thing you rely on most? If it's cash, it loses slowly, quietly, predictably. If it's income, it lags. Raises come late. Costs arrive early. If it's fixed payments, it struggles. The real burden grows. If it's assets, it adapts. That doesn't mean assets are safe. It means they have optionality. And optionality is everything in uncertain regimes, because certainty disappears first, not opportunity. When the rules stop being stable, flexibility becomes the asset. Not conviction, not confidence. Flexibility, the ability to move, adjust, survive mistakes, and stay in the game long enough for probabilities to work in your favor. That's why governments always choose inflation over default. Default is loud. It's immediate. It's political suicide. Somebody has to stand at a podium and admit failure. Markets freeze, confidence collapses, power shifts instantly. Inflation doesn't do that. Inflation is quiet. Inflation is gradual. Inflation doesn't require a vote. Nobody ever gets asked if they agree to it. It just shows up slowly, month by month, receipt by receipt, renewal by renewal. The burden doesn't hit everyone at once, and it hits savers first, then wage earners, and then retirees. And by the time it's obvious, the damage has already been done. That's not a conspiracy. That's design. That's how every heavily indebted system has behaved throughout history when paying the bill becomes politically impossible. And this is exactly why crypto keeps getting pulled into the picture. Not as rebellion, not as protest, not as some ideological statement, but as plumbing. Infrastructure, a rail, something that moves value when traditional channels become constrained, slow, or subtly hostile to holding purchasing power. You don't need mass belief. You don't need everyone chanting slogans or flying flags. You just need enough people to use it because it works better for a specific purpose. That's how real systems spread, not through belief, through utility. Most people misunderstand that. They think adoption is emotional. It isn't. It's mechanical. People don't adopt things because they love them. They adopt them because the alternative quietly becomes worse. And that's the phase we're in now. Now here's the reframe most people miss, and this is where a lot of investors hurt themselves. This isn't about beating the system. Anyone who tells you that you're going to outsmart governments, outplay central banks, or escape the rules entirely is selling you a fantasy. Systems this large don't get beaten by individuals. But you don't need to beat the system. You just need to not be crushed by it. That's a very different objective. Beating the system requires perfect timing, perfect information, and zero mistakes. Not being crushed requires awareness. It requires understanding what environment you're actually in, not the one you wish you were in. You don't need perfect timing. You need awareness of pressure points. You don't need maximum exposure. You need survivable exposure. Exposure that lets you stay solvent when volatility spikes. Exposure that doesn't force decisions at the worst possible moment. Exposure that gives you room to breathe when narratives flip overnight. Most people don't fail because they're wrong. They fail because they're right too early, too concentrated, or too rigid. They bet like certainty exists when it doesn't. You don't need certainty, you need adaptability. The ability to change your mind without blowing up your account. The ability to sit through discomfort without panicking. The ability to recognize when the rules are shifting instead of pretending they aren't. Because this reset is not a moment, it's not a date, it's not a headline, it's not a single announcement that rings a bell and tells you everything changed. It's a process, and it unfolds through policy decisions that look reasonable in isolation, through rate cuts that seem small, through language that sounds supportive, through incentives that push behavior without ever forcing it. And that process is already underway. So if you're waiting for an announcement, you're late. If you're waiting for panic, you're early. And if you're waiting for clarity, you'll wait forever, because clarity only shows up in hindsight. The people who do best in environments like this aren't the loudest or the boldest. They're the ones who learn continuously and act patiently. That's the only real edge retail investors ever have: education and patience. Not inside access, not special treatment, not political influence, not bailouts, just understanding the environment well enough to make fewer mistakes than average. That's it. That's the game. And right now, the environment is telling you something very clearly, whether you want to hear it or not. Debt will be managed, not repaid. Inflation will be tolerated, not crushed. Liquidity will be adjusted, not eliminated. And assets will remain the release valve for pressure that has nowhere else to go. Crypto sits inside that valve, whether people like it or not as a hero, not as a villain, as a mechanism. If that makes you uncomfortable, that's good. Discomfort is a signal to learn, not to freeze. If that makes you defensive, that's normal. Nobody enjoys realizing the rules are different from what they were taught growing up. But if that makes you curious, if it makes you want to understand rather than react, that's where opportunity actually starts. Subscribe or watch the next video.